Okay, in these next few videos we're going to be looking at some demand and supply side policies that can be used to influence each of the goals. So the first video is going to be about the two major demand side policies. So when we're looking at demand management policies, what we're looking at is policies that are likely to impact the level of aggregate demand or total spending on Australian goods and services. So we're really looking at things that are going to impact consumption, investment, government spending or net exports throughout the economy. And there are two demand management policies you need to be aware of: monetary policy and budgetary policy. In terms of demand management policies work in a counter-cyclical fashion. And what I mean by that is they act to smooth out the business cycle. So when we're in a peak and the economy is growing too fast and we're experiencing excessive inflation, it's a sign that we're likely to experience inflation, and policies are likely to be more contractionary. So we'll be using budgetary and monetary policy to slow the economy down. And when the economy is growing poorly or in a weak fashion, then we're going to be using monetary and budgetary policy to try and increase economic activity and increase economic growth. So counter-cyclical means they work against the business cycle, either slowing down the economy when it's growing too fast or making it grow faster when it's growing too slow. So as I said, there are two main types of policy. Monetary policy is related to interest rates. So anything to do with interest rates is not budgetary policy, it's part of monetary policy. And budgetary policy is changes to the government's level of spending and taxation. So all the stuff they spend money on, which we'll talk about later on, and any changes to their taxes are part of budgetary policy. Interest rates, not budgetary policy, part of monetary policy. So monetary policy are changes in interest rates, and they're implemented by what we call the RBA, or the Reserve Bank of Australia. And the RBA's goal is to try and use interest rates to either promote employment and growth, or when growth is too strong, to slow down inflation. So monetary policy is the manipulation of interest rates by the RBA. Fiscal policy refers to changes in the government's receipts and payments in a particular year. You'll hear the words expansionary and contractionary policies, and we'll talk about them more in future slides. But both these policies aims to stabilise a level of economic activity. So in relation to monetary policy, the RBA meet on the first Tuesday of every month. So they get together on the first Tuesday of the month and decide what we call their monetary policy stance. So are they going to implement more expansionary monetary policy, which means they're going to lower the interest rates, or are they going to implement a more contractionary monetary policy, which means they're going to raise interest rates? And what they do is they look at a whole range of factors that impact inflation to see whether they should raise or lower interest rates. And when they lower the cash rate, which is the interest rate they change, that then flows onto all these other interest rates throughout the economy. So when the RBA raised the cash rate, that will flow on to impact the rates for mortgages and car loans and credit card loans, which then has a flow-on effect to consumption and investment spending. So interest rates impact firms and households' borrowing costs. So when interest rates are increased, firms and households experience higher borrowing costs, and that discourages them from borrowing, because they don't want to pay back so much. Changes in interest rates have a big impact on how much people spend or save. In a recession, when the economy is growing poorly and we need to increase economic activity, the RBA will implement expansionary monetary stance and try and cut interest rates so that people will borrow and spend more. When economic activity is too fast and inflation is starting to emerge, the RBA will adopt a contractionary stance. They'll raise interest rates, and then people will prefer to save. There'll be less consumption spending because people don't want to go into debt, and they also will have less discretionary income if they've already got loans, and businesses will spend less because they don't want to go into debt as well. Budgetary policy refers to revenues and expenditures for the next year. So the budget is outlined in May, and basically what it is all the changes to revenues. So that can be changes to income tax, other forms of tax, so excise taxes on fuel or for like cigarettes and alcohol, sales taxes like GST, company taxes, superannuation taxes. The government also collects money through people paying back their uni fees. Any changes to either revenue or government expenditure, which includes mainly social security and welfare, which is this chunk in here, general public services, so defence force, teachers' wages, education spending, which teaching would actually be in there, health spending on hospitals, as well as spending on just general public services as well. They're the main government expenditures. And as you can see, this represents how much the government spends in each of these areas. So most of their spending goes towards security and welfare, with the second highest being other purposes and then health. When we're looking at the budget outcome, we're looking at the difference between revenue and expenditure in a given year. So when we say we've got a balanced budget, it means that the total amount coming in, so all this stuff here, is equal to the amount coming out through expenditure in a given year. A deficit means that expenditure exceeds receipts, and a surplus means the government's collecting more money in that year than they're spending. Generally, we consider budget deficits, so when the government's spending more than they're earning, to be more expansionary. So expansionary policies refer to policies that are going to boost economic activity in Australia and therefore boost aggregate demand. So that can include reducing taxes, increasing government spending, which will all lead to higher budget deficits. Contractionary policies are policies designed to prevent inflation and slow down the economy or slow down aggregate demand. So that can include increased income taxes, reducing government spending, and they're generally used when the economy is growing too fast or when the government's trying to pay back some of their debt because they're in too much debt. So it can include higher taxes, less infrastructure spending, cutting welfare are all examples of contractionary policies. So some policies from the last budget, the government's made you have to pay more for your HECS, so that would be a contractionary policy. They've increased the Medicare levy, which is a tax on your income, which would be contractionary as well. They have policies to fight terrorism, which is expansionary. They put a levy or a tax on the bank, which is contractionary, are some of the key things they've done in the last budget. Thanks for listening.